Hello and welcome to another technical analysis tutorial video. In this video, I want to talk about the MACD indicator oscillator, and I want to talk about how you can use it to enter trades and to exit trades, and basically to use trends together with the MACD. There's a second way of using the MACD, which is looking for divergences, but we are looking into that in another video. I want to keep it step by step and keep it simple. So what is the MACD? Let's start with that. The MACD is an oscillator that can be used together, just with price action and moving averages, for example, to understand possible entries and exits out of trades. The MACD consists of two lines here. With the blue one is the so-called MACD line, and the red one is the indicator line. And then there's also a histogram, which you don't necessarily need if you use it the way I show you today. But I'll always keep it on the chart because it's just another way of displaying it. So you don't necessarily need it, but I think it sometimes is quite useful actually. So I always keep it on it, but if you think it messes it all up, then you can delete the histogram out of it. But again, I just keep it on it. So the MACD then consists of, as I said, the MACD line. The MACD line is usually, when you look at the MACD down here, the MACD is based on a relationship between the exponential moving average 12-day period and the exponential moving average of the 26-day period, and how they relate to each other. And I basically brought them in here into the price chart. These are the two EMAs, two exponential moving averages, 12 and 26, just to show you how the MACD works, because the MACD, the blue MACD line, crosses the zero line whenever there is a crossover of the two EMAs. And when the shorter term EMA, which is the 12, crosses the 26 to the downside, then it also, the MACD line, crosses the zero line to the downside. And if that crossover happens the other way around, so the 12-day EMA, the shorter term one, crosses the 26-day, the longer term one, to the upside, then we have a crossover to the upside of the zero line of the MACD line. Just to show you that more clearly, I will bring in two vertical lines here, and then we can see that, and then we can also understand how we can use the MACD indicator to enter and exit trades. So I'll put a vertical line in wherever we see that crossover of the zero line of the MACD line, and then we can take a closer look at it. So it's somewhere here at the beginning, yeah, so it doesn't need to be very exact now, but here in the beginning, somewhere there is a crossover of the zero line of the MACD line. Here there is no crossover anymore, so we go further and further. Here there's one crossover then to the downside of the zero line, and another one very shortly after that to the upside of the zero line. Here again we're crossing it very shortly below the zero line, and then again above, and then again cross below zero for a while, and then cross again to the upside of the zero line. And again, whenever you now see this vertical line here, this is also where the two exponential moving averages were crossing. And I just have these in the chart just to show you how the MACD works. You normally don't need both. So you don't need the EMA 12 and 26 in your chart if you have the EMA, if you have the MACD. I just want to show you how it works. Now, you can possibly then, also if I zoom in a little bit, just to show you, here you can clearly see that whenever we have down here the blue MACD line crossing the zero line, we have these exponential moving averages crossing each other as well. So again, what I want to talk about is the MACD line. The MACD is just one indicator. It indicates. It doesn't need to work all the time. Yeah, you always need to use it together, maybe with trend lines, for example. And you need to read the candlesticks, need to understand the price action, because it doesn't always work, but it's a really good indicator. So what you need to look out for, and I zoom out a little bit, are really these sort of fake outs, where we've got these two here, a cross here, and another cross here and cross here, just briefly afterwards, because if you use that to enter and exit just based on that, it can really give you a false indication. But let's just assume we start over here, and this is the first crossover where we have the MACD crossing above the zero line. So this is then a bullish indication, and you could have entered a trade here, right? So if you had entered your trade here, you would have made a profit, let's say, from, you would have entered at around, yeah, probably 10 cents, and you've gone all the way up, you've stayed within the trade, and let's say you've really cashed out here before that sort of fake crossover, and you've made basically a profit from 10 cents, you've gone up to $1.25 or something. So that would have been a really good trade, but you can clearly see you would have missed out on that major move to the upside here. That's why it's so important to use other indicators as well. But that was really just a very brief one, a very short crossover. Yeah, so there are ways of understanding that. So you can look at other moving averages and combining indicators, but I'll show you in another video how to combine different indicators as well. But this was only a fake out. Then again, it would have moved up. Just assuming you would have seen that fake out, you would have stayed within the trade. You could have all gone all the way up, but you probably would have then missed out on cashing out and would have gone all the way down again to that crossover here. Again, a fake one. And then, but you could have traded it. You could have still traded it on a shorter term time frame. Yeah. So this is the daily chart, obviously. So it might have worked depending on your preference. You could have traded all of that on a shorter term time frame as well. But then the next main one we've got here, and this would have been a signal to short because the blue MACD line is crossing below zero, so indicating a downtrend. And yes, you can clearly see you would have probably entered the trade here at something around 166 until there's another bullish crossover, and here you would have probably entered a short position here and then realized your profits at 133, which is when you would have entered a long position again from 133, and then you would have gone up all the way to up here from 133 to 295. Currently we are moving down with the MACD, but the MACD line is way up here. You can't even see it currently here. I would need to make that smaller. So it's just getting horizontal, still in a strong uptrend. It will be a while until we drop, but yeah, this would have been a really good indicator. And if you understand trends, if you want to ride trends, the MACD indicator can be a really good indicator for entry and exit. But if you want to be on the safe side, also always take a look at the 4-hour charts. But here you can see it would have given you a really good indication here to enter the trade, really nice profits. Here it wouldn't have worked out, but then again, it's important to use stop losses as well and use other indicators like the moving averages, for example. You could have used a longer term moving average here, and to understand, are we still in an uptrend? Let me just for fun, let me bring in the moving average, just a simple moving average. So it's, as I said, this is only one indicator. You always need to combine it with other indicators as well to give you signals. So let's say we would have used maybe a 50-day moving average. Let's see, and what you would have seen, the 50. Let's just try the 100. So with the 100 moving average, you would have seen that we would, had you combined now that MACD with a 100-day moving average, you would have seen that we would have still been in an uptrend. So maybe because of that, you wouldn't have cashed out. So you could have waited until we break that 100-day moving average. But so yeah, it's important to combine these together. But I think it's quite good. Over here, the MACD would have indicated you at least one time to enter a long trade. Here a short fake out, but again, you could have used a stop loss. Here you would have probably gone into a long trade again, down from 121. And even if you had missed out on cashing out up here, you would have probably cashed out here at 160, still a good gain, or here, yeah, at 160. So this is how you can use it, just by using the MACD to see when it's crossing the zero line. And these are oftentimes good buy and sell indicators. This was how you can use the MACD to enter and exit trades. If it crosses above the zero line, enter the trade. If you cross it below the zero line, the MACD line, exit the trade. One way of doing it, or enter a short position then. And in the next video, I'm going to show you how you can trade divergences to understand when a trend reversal could be happening. Okay, so I hope you liked the video. If you did, please smash the like button. And if you want to follow me on this trading journey, then please subscribe. Thanks a lot for watching and see you in the next video. Bye.